Sydney, visiting the Russell Investments office, and with me today is Scott Fletcher, that a number of you know, who comes to speak at our client function generally in December, giving us an economic update. So with all these trying times that we're having in the world, as we see in the news every night, I thought it'd be a good time to have a bit of a catch up with Scott and get his views on the way things are operating in the world of money today. So to kick off, can you give us a little bit of experience of your what key drivers you see at the moment, Scott, with investment returns?
Sure. So the way we build portfolios, Peter, particularly for those that many of your clients would be invested in, there's really three key drivers of investment return in any portfolio, multi-asset portfolio that we run. The first is asset allocation, the second would be manager selection, and the third would be implementation. And when it comes to asset allocation, we break that into two parts. So effectively there's four drivers. One is long-term or strategic asset allocation. The second is what we'd call shorter-term or tactical asset allocation. And then you get the manager selection and the implementation. Now, that said, it's probably useful for those of your clients listening in to understand the context in which we put those drivers together in a portfolio. So all of the drivers that we put together are in the context of what outcome do we need. So that's the starting point for any portfolio construction type of capability or approach that we have. And it's about what's the return that we need, or what risk levels do we need. It's some combination typically of risk and return. There are other factors that come in and so on. So that's the starting point question. And then each of those drivers we bring into the equation, if you like, by answering three further questions. So the first one is, what asset mix do we need to get the job done? So given that return or combination of return and risk objective, what asset mix? What combination of different types of asset classes like equities or bonds and so on? And that's what we call our strategic long-term asset allocation. That is by far the biggest influence on achieving the investment objective over time or through the course of the cycle. The second question that we ask is, given that mix, so effectively you come up with that strategic allocation, but it's really not yet an investable portfolio. It's almost like a theoretical portfolio. Okay. So then we have to move to, how best do I access each of those asset classes? Should I use active strategies? In other words, trying to beat a benchmark. I'm using external manager strategies. Should I use passive investment strategies? What sort of way should I access those asset classes? That's the second part where manager selection or strategy selection comes in. Right. And then the third question we have to ask is, do we have to adjust anything along the way to account for emerging opportunities or risks? Because that's the tactical asset allocation side as well. Yeah.
Okay, so the key drivers, what I see with Russell is so big, and your depth and breadth right around the world is just absolutely amazing. I saw a video recently about Russell. I can't remember the exact figure, but you might have a more of an updated figure. The amount of money that Russell transacts on an annual basis, have you got any idea?
Yeah, so the big trinity of numbers that we talk about. So we are a global asset management firm headquartered in the United States, and we manage in Australian dollar terms approximately $390 billion. So that's a multiple of any of the largest Australian funds, industry funds, or
that's
whatever that you'd see.
No,
that's globally. Within Australia, we would manage approximately, Australia and New Zealand would be approximately 30 billion.
Right.
But we have a 24-hour capability in terms of trading desk, where we would trade over 3 trillion Australian dollars globally each year, not just for our own portfolios, but also for even peer-to-peer, like-for-like competitors of ours use us to transact some aspects of their portfolio. And we're also a pioneer in the global asset consulting industry. So we advise on a blue chip client base around the world, approximately just over $3 trillion as well in Australian dollar terms.
So big money. And so you also do the consulting asset management also for other firms as well, don't you?
Yes, we do.
Yep. Yeah, so that includes not just the typical mum and dad super funds, but also industry super funds and corporate funds, and even involved in some of the large statutory funds, I understand.
That's right. Yeah.
So
Yeah.
governments use you and so forth?
Some of the largest pension funds in the world we advise to, we're the consultant for. We also manage very large defined benefit schemes in Europe and the United States. Also in Australia we do defined benefit as well. But we're across the whole spectrum from institutional to mum and dad retail.
So that's what I like about the enormity of the capability of Russell. And that's when I went to see the Seattle head office quite a few years ago and just saw the trading desks and all the other things that they have there. It just made me realise that the enormity of the transactions and the other activities going on. And with the weekly updates that Russell give about their views on where they see the markets heading, I thought that's very useful.
Yes.
And I actually put that on my website most weeks. So clients can have a look at that and have access to information. So where you're seeing things at the moment, a lot of people in their mind with the media about the trade issues with Trump and all these sort of issues that are going on, the sensitivities with Australia being a trading nation. How do you see that's going to play out, or is playing out with us at the moment?
Well, I think stepping back, the big question to ask, and one of the things that you'll find is probably a broader set of views in terms of the short-term direction of markets out 12 months or so. There's some argument across the industry and between fund managers about the timing of when the next slowdown comes, but what there is definitely agreement on is 5 years out when you build a portfolio, it's a lower return outlook given that we've done so well. The Trump trade issues and so on, it's really about the risk of escalation. So when it comes to will there be retaliatory tit for tat, trade arrangements or trade threats leading to a bigger global trade war? We don't see it as a trade war at this point, we see it as a trade skirmish. But it's just another thing that adds to the volatility, because this is very much a late cycle, momentum driven, and in the United States market context, expensive market.
Sure.
And so when you see these big volatile transition periods, which is what we think we're in the start of in 2018, the hallmark of those periods is really very much volatility. You see it at market peaks, turning points, in terms of turning points, and you see it at market troughs. But we think we're very much in the start of a volatile transition phase. And as I said, trade wars is one aspect over and above things to do with geopolitical risk, high valuations in the US stock market, what's happening with the tech stocks and so on. All of this is very indicative of a late cycle environment where we can actually see the US economy slowing down significantly as a scenario towards the latter part of 2019 into 2020. Of course, markets look 6 to 12 months ahead. So in our 12-month strategy window, we're already looking at more of a defensive bias to our portfolios in anticipation of the term to come.
Okay. On the other side of things, we have new industries like the battery storage, and coming from your old state you used to live in, where I live in West Australia, the lithium industry or mining industry and all the other battery minerals is seen to be taking up in a big way. With the fund manager you utilise in your portfolios, what sort of bent are they having, or focus on the sort of renewable type of activity, and also you've got this new environmental social responsibility fund is also too. So can you speak a little bit to those?
Certainly. So when we address responsible investing, we do it in a couple of ways. So it's not just a particular slice of a portfolio or a particular product. It's actually embedded into different stages of our investment process. So even in the way we research managers now, we have a responsible investing score or aspect to how we rate that manager. And particularly in places like New Zealand or clients in the Netherlands, they'll be very big on cluster munitions and so on. When it comes to renewable energy and so on, that is certainly a focus, and has become more of a focus over time. But in terms of achieving an investment objective and how managers are looking at it as an investment opportunity at the moment, a lot of the more or the larger technology stock exposures, a lot of those are quite expensive at this point in time. So even though it's a bias and something that we bring more and more into our portfolio construction, you have to overlay it with how expensive is it at the moment, how good an opportunity is it at the moment, and that's all about risk management. So we incorporate renewable energy strategies and so on in through the external managers that we use in the fund, and even our own internal strategies that we can put in our portfolios. But that said, it's very much about, at this point in the cycle, we don't want to be adding to equity risk. We want to be becoming more of a defensive bias. So we put it in there, but it's in the context of overlaying that with how good an investment opportunity is it right now.
Because my concern about renewable energy, for example, is not about the concept. It's just the fact that it's heavily subsidised at the moment. And if governments, with their budgets constraints, start loosening their subsidies for this area, how well will these new energy players be able to stand up in the commercial environment? So that's something. So I'm interested to hear about your comments.
There's no doubt that if you're talking information technology or digital disruption, renewable energy, those sort of themes, most of the driver of what's happening in markets at the moment is very much in the large mega cap end. Right. It's not the smaller boutique, we've got a new idea sort of renewable energy. That's the small cap space, but most of the driver of markets is very much large mega cap, internet services, internet type, digital disruption type of stocks.
Well, the FANGs have had a bit of a going over, Facebook recently. So is that because there's been an overplay in that sort of field, and investors been speculating on that sort of Nevada that it's going to keep on going up and up without some sort of correction?
Yeah, there's a phrase that I was told once that I very much adhere to, and that is, when you hear the phrase "this time it's different," you start to get alarm bells. You know, I remember back in 1999 and 2000, just prior to the tech wreck. Yes. There's bits and pieces of the technology sector at the moment that sniff a little bit like that. Some of the price earnings and the multiples are extremely high, but at this phase in the market, we say late cycle momentum driven for a very good reason, and that is what's hot right now.
Yes.
A lot of investors, particularly in the retail space, we see it a lot, investors will just jump on. So they might be worried about valuation of large mega caps like your FANG stocks, which is your Facebook, Apple, Amazon, Netflix, Google, just for those who don't know what a FANG stock is. It's just something economists come up with. But it's like fear of missing out, the FOMO factor, if you can call it that. And so even though they might be worried about valuation, there's this capitulation point at which, oh my goodness, I might miss out, so I'm just going to jump on and try and ride as much of this out as I can. The problem that creates for retail investors is, at around a turning point in the market, you've got two choices, right? You've got, will I pick up the dimes on the road before the turn? But then the flip side to that is, will I get run over by the steamroller that's coming because of the big, large fundamental risks that are very much there now over the other side of the hill? So what we do is we do investment strategy across two real time frames. Short term, we don't want to leave too much money on the table, but we don't want to load up in equity markets risk at this point in the cycle. While to address the bigger, larger fundamental risks, we get more defensive in our strategic asset allocation, which is what I mentioned at the outset.
Scott, one of the things I like about Russell is the diversification story that you preach, and the thing that I explain to my clients how important it is to invest this way, not relying on one asset class. Now, your construction of your portfolios, you go to, as an organisation, go to great lengths and spend a lot of money and actually going through and analysing the different types of managers with their different styles in the different sectors. And so could you just explain a little bit about the processes that Russell go through in selecting the best of breed in those particular areas?
Yeah, so as you alluded to, we very much have a global manager research capability that's seen as a global leader and is very much at the top of the ratings globally each year. We have manager research team members in every major region. So we have them based in North America, for example, where a lot of the manager base is located across asset classes. There's managers in Europe, continental Europe, UK. We have manager researchers, and that's all they do. They specialise in manager research in each one of those major areas. part of the research effort as well is we don't want to pay top dollar for to bring or to utilise managers in our portfolios for things that we could actually do ourselves more cost efficiently. So we do a very large deal of research to get to the bottom of what is driving an actual manager's ability to outperform the market. So it's about testing their thesis, if you like, for what makes them think that they can consistently outperform their particular market or benchmark, whether it be equities, bonds, infrastructure, some other alternatives, asset class, and so on. We want to make sure that it's just that they're not in the right place at the right time. So a value manager looks really good compared to a broader market index, but if it's just the fact that value type of stocks have gone up, then we don't want to pay for that sort of capability. We want to pay for real skill. So a great deal of research goes into identifying how much is actually what we would classify as actual real skill. We will employ that into our portfolios, but we certainly won't be employing right place at right time type of managers. So we've done that for an awful long time through the history of the organisation, going back almost half a century. And it remains a very core capability of what we do. In portfolio solutions, we will utilise predominantly active strategies, like utilising external managers, but we will also utilise passive strategies from time to time, or index strategies, and we'll use things in between, which we'll call factor portfolios, which is for another discussion.
Yes.
But effectively, we will take a whole of portfolio approach to providing an investment outcome in return or risk, or whatever the case may be. But active manager research has always been and remains a core capability of the business.
Well, that's really good, Scott, and I really appreciate the time today, because it's really good to have a catch up. And you're coming over to Perth again in December.
Yes, I am.
For our client function. So
yes.
We value your time coming over and giving our clients an update. But this is an interim one, I guess. So it's good to get the latest what's happening here in Sydney, and so we look forward to seeing all you soon back in Perth, and looking forward to you soon coming to our client function in December. And I want to thank you, Russell, and your Russell team for putting this on for us today.
Thanks very much.
Thanks very much.
Thank you.
Thanks, Scott. Cheers. Thank you.